Hello everyone. Thanks for joining in. We'll wait for like 1 or 2 minutes more for other persons to join in, and then we'll start in next 2 minutes. We'll wait 1 more minute, and meanwhile, it would be great if you can introduce yourself in the chat box and say hi. Okay, great. I think we can start now. Good morning, good afternoon, and good evening to everyone. Welcome to the eighth edition of our Commodity in Focus webinar series, where we will be talking about food inflation outlook in the backdrop of El Nino. My name is Hemant Bansal, and I'll be your host for today's webinar. I'm based in India and currently heading the Commodity Intelligence Solution at the Smart Cube. I've been in this space for more than 12 years now, and my responsibilities include, working closely with various teams within my organization, as well as with the clients, to ensure that we are providing the best possible solution customized to our client requirements with respect to commodity inflation or volatility management needs. I'm also joined by my panelists Kumar, Amit, and Nidhi. Kumar specializes in agro commodities, especially grains market, and Nidhi specializes in veg oils and soft commodities like cocoa and sugar. Both of them are closely tracking, all developments happening around the agro market, and they will be talking about their analysis, you know, as to how they expect agro commodities to trend going forward in 2024, both not only in 2024 but both in the short term and in the long term. So let's quickly look at today's agenda. First, we will talk about what is El Nino and its impact across key geographies and on various crops. Analysis of previous El Nino years, highlighting the extent of similarities or differences within the current scenario. Then we will also talk about supply demand scenario and 2024 price outlook for key agri commodities to monitor. And lastly, we are going to look at some of the key factors, or events other than El Nino, which may pose a risk to the price forecast. And we will also dive in into the strategies you can apply to mitigate some of the impact on your business. Towards the end, we will also leave some time for questions and answers. Therefore, throughout the webinar, request you to keep posting your questions in the Q&A box and not in the chat box, please, which you will find at the bottom of your screen, so that everyone can see them and upvote them as well. So yeah, that's about the agenda now. Quickly starting, and I will hand over the mic to Nidhi. Over to you, Nidhi. Nidhi, you're on mute.
Sorry, thank you, Hemant. So let's start first with understanding what is El Nino and how it is measured. El Nino Southern Oscillation, that is ENSO, refers to periodic fluctuations in the sea surface temperature across the central and eastern tropical Pacific Ocean. These fluctuation influences global temperature and precipitation patterns. ENSO now can be classified into three categories, namely La Nina, El Nino, and a neutral phase. La Nina generally leads to cooler than normal weather, while El Nino leads to warmer sea surface temperatures. Episodes of El Nino and La Nino can last for about 9 to 12 months, and they usually occur every 2 to 7 years. However, in some cases, El Nino can persist for years. Like in the recent La Nina phase, it lasted for about 3 years between 2020 and 2022. The year this year, ENSO is likely to transition into an El Nino phase, and it is likely to stretch into the quarter one of 2024. To measure, assess, and predict ENSO, NOAA, that is National Oceanic and Atmospheric Administration, uses an index called Oceanic Nino Index or ONI. ONI is defined as a 3 months running average of sea surface temperature from its departure. Here in the graph, we can see that ONI value greater than or equal to positive 0.5 is characterized by El Nino, and it is depicted in red color, while ONI value less than or equal to minus 0.5, it is called La Nina phase, and it is represented by blue color. Also, in terms of weather intensity, higher the absolute value of ONI, more extreme the weather event would be. For example, ONI between 1 to 1.5 is moderate El Nino, while value above 2 is represented by a very strong El Nino event. Historically, the years 2015-16, 1997, 1998, and 1987-88 have witnessed strong El Nino period. Now, an important aspect we need to understand is what is the likelihood of El Nino and its impact on the crops. Here, as we can see on the screen, we have plotted the probability of moderate and strong El Nino pattern developing this year. So according to NOAA, there is more than 95% chances of El Nino forming during October of 2023 till March of 2024, of which the likelihood of moderate El Nino is more than 95% for October 2020 to Jan 2024, while there is 71% chances of strong El Nino in quarter 4 of 2023. El Nino episodes disrupts normal patterns of tropical precipitation and atmospheric circulation. This may trigger possibly extreme climate events across the globe. Agriculture is one of the main sectors of the economy that could be severely affected by El Nino. And now let's have a quick look at its potential impact on different geographies and crops. So El Nino is typically associated with droughts in Australia, Indonesia, parts of South Asia, West and Central Africa. These regions are highlighted by red color in the map. However, the event can lead to excessive rainfalls in other parts of the world like Latin America, southern US and Mexico. In the map, we have highlighted these regions in blue. Since El Nino leads to varied temperature across the globe, its impacts on the crop also differs. For example, yields of the crop grown in the regions which receive lower than average rains are negatively impacted. And these crops are sugarcane in India, China, and Thailand, wheat in Australia, India, and China, palm oil in Indonesia and Malaysia, and cocoa in West Africa. However, countries which receive higher rains, they benefit from the improved soil moisture and higher yields. And the key crops grown in these regions are corn, wheat, sugarcane, and soybean. Now, after understanding the potential impact on El Nino on different crops, Let's see what is the outlook for key commodities in the food basket, namely vegetable oils, grains, and softs. Starting with vegetable oil basket. The graph on your screen shows annual production growth rate during the past strong El Nino years and comparing it with their past 15-year average growth rate. As it is evident from the chart that palm oil production either falls or it grows at a slower pace during the El Nino phase. Also, as we discussed earlier, this is because El Nino causes lower than average rainfalls in key palm oil producing regions of Malaysia and Indonesia. Additionally, El Nino also increases the risk of wildfires, as this was the case in 2015 when forest fires in Indonesia spread more quickly due to normal than drier weather, and it created heavy haze in the Southeast Asia. This reduced the amount of sunlight reaching the trees, and it also stunted palm fruit growth. As a result, global palm oil output during this period fell about 5%. However, the production in marketing year 1987-88 grew despite an El Nino year. This was attributed to the fact that even though palm oil yields declined 0.5% during this period, acreage grew about 6%, hence leading to a rise in output. Next, moving to soybean. From the graph, we can see that unlike palm oil, soybean production tends to rise during El Nino phase, as El Nino causes favorable weather in key soybean producing regions, which are US, Brazil, and Argentina. Also, at times, the impact of El Nino can be observed in production with a lag of 9 to 12 months. For soybean, this was the case in year 2015-16 when soybean output dropped 2%. However, it grew 11% in the subsequent year, which was reiterating the fact that El Nino can have a lagged impact on production. Now, if we look at the production outlook in marketing year 23-24, which is again expected to be an El Nino year, we expect palm oil to grow at a reduced pace of 1.5%, while soybean output is likely to increase by about 9%. Now, before jumping to the price outlook for these vegetable oils, it is very important for us to understand supply-demand dynamics of the market to get a broader view of the market, as there will be factors apart from El Nino which may influence prices. Starting with palm oil, we have plotted stocks to use ratio along with its past 5-year average trend. The global stock to use ratio for palm oil is projected to drop from 22% in marketing year 22-23 to 21% during marketing year 23-24. This is because of 4.6% growth in consumption driven by increase in demand from the food sector and biodiesel sector may offset a production increase. The key reason for the rise in production is
Sorry, I think there's some internet issue with Nidhi. Nidhi, are you back? Sorry, Nidhi, we can't hear you. Nidhi?
23 to 9% in marketing year 23-24 amid the rise in stocks in Brazil and Argentina. These two countries together accounts for 30% of global soybean oil production. So this can also be seen in the graph. The ratios are increasing for soybean. Brazil is likely to sow another bumper crop this year, which is after witnessing a significant growth last year. Likewise, Argentina is also projected to witness a sharp recovery in its output The soybean output is likely to grow by about staggering 100% in marketing year 23-24, compared with last year when the country's output fell because it faced worst drought in last 50 years. However,
Sorry,
US,
Nidhi, can you hear me?
yes, Hemant.
Sorry, Nidhi, we missed you for like a couple of minutes, so just request to can
Uh,
we start with slide 10 right from the start because I think we missed you there because of the internet connection.
okay, so do you want me to start with palm oil stock to use ratio?
Yes, the slide 10, yes,
Sure.
right from the start. Thank
Sure.
you.
Apologies for the miss.
No
I will
worries.
again start with the palm oil stock to use ratio. So here, the palm oil stock to use ratio is likely to drop from 22% in marketing year 22-23 to 21% in the next marketing year because a 4.6% year-over-year growth in consumption is driven by increased demand from the food and biodiesel sector. Production is also likely to increase 1.5%. This is because even though yield growth is likely to stagnate, the increase in acreage will be responsible for this higher production. Next, moving to soybean oil, we see that its stock to use ratio is expected to increase from 8% in marketing year 22-23 to 9% in marketing year 23-24. The reason for this is higher stock levels in Brazil and Argentina. These two countries together accounts for 30% of global soybean oil output. Brazil is likely to witness another bumper soybean crop in marketing year 23-24, witnessing a significant growth for the second consecutive year. Likewise, Argentina is projected to witness a sharp recovery in soybean output, up by a staggering 100% in marketing year 23-24 compared to last year when the country's output fell because it witnessed worst drought in past 50 years. However, the US, which is the second largest producer of soybean, is likely to experience about a 3% year-over-year fall in output owing to fall in its acreage. Additionally, the recent dry weather in the US also negatively impacted the yields and resulted in crop deterioration. Now, if we look at the demand side of this, soybean oil consumption is projected to grow 5% during marketing year 23-24 amid strong demand from the biodiesel sector in the US and increase in food consumption. After developing an understanding of supply demand fundamental, let's look at the price outlook for these vegetable oils. Prices for the vegetable oils have been on a downtrend since June 2022 on account of high vegetable oil supply and weaker than expected demand amid recessionary fears. Removal of palm oil export ban by Indonesia, bumper soybean harvest in Brazil, resumption of sunflower oil supply after the grain deal between Russia and Ukraine, and lastly, the record high rapeseed output in Australia, Canada, and Europe ensured ample vegetable oil supply in the market during the second half of 2022 and in the first half of 2023. Additionally, the recessionary fears, high stock levels in India, lower than expected demand from China also exerted downward pressure on the prices. However, as we step into the marketing year 23-24, vegetable oil prices are likely to rise from current levels owing to supply shortfall in vegetable oil market due to slow pace of production growth, likely pickup in demand, and uncertain geopolitical outlook. Discussing these factors in detail, let's look at supply first. As discussed earlier, soybean output in the US is projected to decline amid the ongoing drought situation. Further, continued drought conditions in Argentina also poses a threat to soybean sowing in this season. However, this threat may be partially offset by the fact that farmers may prefer soybean sowing over the corn due to former being more water efficient crop. The next is palm oil growth, which is also likely to be stunted due to stagnant yields in Indonesia, while aging palm oil trees and persistent labor shortages may add to production woes in Malaysia. Lastly, Canada and Australia are also witnessing extreme drought conditions due to El Nino. This may result in 31% and 5% fall in their rapeseed yields for the upcoming year. Australia is also expected to witness a fall of 10% in its acreage. The next factor impacting prices would be higher biodiesel mandates. Indonesia implemented its B35 biodiesel mandate nationwide in August 2023, and it is now targeting a higher biofuel mandate of B40 by 2030. B40 implies 40% of palm oil blend with diesel. Higher mandates will imply higher demand for the vegetable oil. US EPA also increased its biofuel blending volumes by 3% for 2024, and Brazil aims to increase its mandate from B13 to B14 in April 2024. Firm demand from the largest veg oil importers, India and China, may also support the price uptrend. India recently witnessed poor rains in the oilseed growing states. This is likely to reduce its production and may increase the country's dependence on the oilseed imports. Lastly, the projected growth in Brent crude oil prices due to supply curbs by OPEC and high demand amid expected macroeconomic recovery may also push up the vegetable oil prices. There are few key downside risks to our prices, and these are first being strong soybean output growth in Brazil and Argentina, which is likely to keep soybean stocks elevated globally. Next is the EU's Renewable Energy Directive, which caps the use of palm oil in the biofuel sector at 2019 levels till 2023 and is likely to phase it out by 2030. This may reduce the palm oil demand from Europe, which is the third largest palm oil buyer after India and China. Now, after having discussed vegetable oils price outlook in detail, let's move to soft commodities. Here, we will be focusing on two key crops which are expected to be impacted by El Nino weather developments. These are sugar and cocoa. Let's have a closer look at the impact of El Nino weather in past years on both sugar and cocoa. Starting with sugar, as demonstrated in the graph, historically, global sugar output has shown a mixed trend during El Nino years. This is because a likely drop in production in South Asian countries, including India, China, and Thailand, amid the dry weather, may be counteracted by the increase in Brazilian sugar output, which is the largest sugar producer in the world. However, excessive rains in Brazil due to El Nino may reduce surplus content in sugarcane and can also cause flooding in the fields, which may disrupt harvesting. For cocoa, as evident from the graph, the output typically declines during El Nino phase as West Africa, the largest global cocoa producer, witnesses drier than usual weather, resulting in the lower yields for cocoa. A peek into the next year shows cocoa output is likely to decline while sugar output may grow but at a lower pace and remain below the past 15-year average growth rate. Now, let's closely look and analyze the supply-demand pattern for these two commodities and how it is expected to change next year. The graph shows that stock-to-use ratio for sugar is on declining trend since marketing year 2021, and it is projected to drop to a 13-year low during marketing year 23-24. The key reason for this is weakening supply. El Nino-led dry season in Asia may cause sugarcane production to decline in two of the top 5 global sugar producers, which is India and Thailand. In marketing year 23-24, Thailand's sugarcane output is expected to decline 18% year over year, while India is likely to produce 31.7 million tons of sugar, which would be 3.4% lower on annual basis and 1% lower than the past 5-year average. Further, low carryover stocks from the previous year will also weigh down on supply. Demand, on the other hand, may remain stagnant because sugar is a necessity commodity. Now, if we look at cocoa, similar to sugar, its stock to use ratio is also on a downtrend since marketing year 21-22 and is expected to reach 15-year low during marketing year 23-24. Major factor contributing to this drop is tight cocoa supplies in Ghana and Ivory Coast, two of the world's leading cocoa producers. Abundant rains in certain regions of West Africa during Q2 of 2023 resulted in an outbreak of the black pod disease in cocoa plantations of Ghana and swollen shoot virus in Ivory Coast, which negatively impacted the crop and impacted production. The heavy rains also created logistical challenges, that is, obstructing roads and preventing goods from reaching the ports in the region. In fact, cocoa arrivals in the port of Ivory Coast fell 3% year over year from October 2022 to September 17, 2023. What's more, the crop quality has also been deteriorated by the lack of fertilizers and pesticides availability due to continued sanctions imposed on Russia, which is the largest fertilizer exporter globally. Cocoa grindings, on the other hand, remained strong and rose about 3% quarter on quarter in Q2 of 2023. Combining the likely impact of El Nino on sugar and cocoa with the broader supply-demand fundamentals, we present the price outlook for these two commodities in the next year. From June 2022 to May 2023, sugar prices rose by a staggering 40%. To describe this sharp inflation in sugar prices, a new term emerged, sugarflation. This sugarflation has come off the back of declining production figures in key producing nations such as India, China, and Thailand. We expect sugar prices to remain firm in near term due to expected global supply deficit of 5 to 6 million tons in the marketing year 23-24, which would be second year in a row. A likely ban by Indian government on sugar exports amid expected fall in its output may add to supply pressures. Monsoon rains in India over the last couple of months were 10% below than the average, and it added to the supply fears. Also, last year, India reduced sugar exports by 45% year-on-year basis due to its lower output and to ensure domestic availability and to keep domestic prices in check. Further, in Thailand, not only sugarcane acreage is likely to reduce, but farmers are also shifting towards more profitable cassava crop. Sugar production in the US is also projected to fall, while it is expected to rise marginally in the Europe. However, the projected bumper sugarcane crop in Brazil, due to increased yields and acreage, may limit the increase in prices. Now, talking about cocoa prices have been on uptrend since October 2022, reaching all-time high during early September 2023, and they're also likely to remain elevated in near to medium term amid expected deficit in the cocoa market, which would be for the third year in a row. As discussed earlier, cocoa supply is likely to be constrained in West Africa owing to spread of swollen shoot virus, black pod disease, and lower yields amid El Nino weather. Owing to tight supply, Ghana recently postponed its Q3 shipments to the next season, while Ivory Coast halted forward sales of the cocoa exports during the marketing year 23-24. So this, along with expected economic recovery, may keep cocoa demand elevated and hence push the prices up in the coming year. Another commodity basket which will likely bear the brunt of developing El Nino weather is grains. So now I would like to ask my colleague Kumar to walk you through grains in detail. Over to you, Kumar.
Thank you, Nidhi. So moving to grains, here we'll primarily discuss two grains, which are wheat and corn. Now, before delving into commodity fundamentals, it's worth noting that El Nino events are irregular in terms of their intensities, frequencies, and the nature of their impact in different places. In some region, El Nino can be a boom, providing extra rainfall that supports crop growth in areas like Kansas and many parts of Russia. In other places, such as Eastern Australia, shifting weather can be devastating, driving up temperatures and forcing drier conditions. The key thing to note here is that even extra rainfall is not always beneficial if it occurs ahead of the harvest season, because it can lead to quality deterioration of standing grains. Now, let's start by examining how the production of these grains were impacted during past El Nino years. As demonstrated in the chart, it's evident that El Nino typically leads to a decline in production. In the previous El Nino years, production of both wheat and corn remained below the 15-year average output, which is reflected through the line chart here. However, there has been anomaly years as well. El Nino did not cause any significant production loss for these grains. One of the key reasons for no significant impact on global production of wheat, particularly in the El Nino year of 97-98, is because of increased output and higher acreage in China. Looking ahead, it's clear that wheat production is expected to decrease in the marketing year 23-24. However, in contrast, corn output for the same period is likely to rise, which will primarily due to a projection of near record high production levels in Brazil. It's worth noting that persistent dry weather conditions in Canada, Australia, and Argentina has the potential to further reduce production estimates, especially for wheat. Also, a key trend to note here is that corn output in the previous two strong El Nino years declined in the top two producing countries, which is US and Brazil. El Nino tends to impact the most vulnerable crop initially, and wheat, a globally traded crop that finds its place in everyone's plate in form of noodles, cake, bread, to name a few, falls into this category of vulnerable crops. Now, the question arises, why should we be concerned about a minor decrease in production? So in the following slide, we'll delve into the reasons why it is crucial to closely monitor the El Nino's impact. Now, in this slide, we'll focus on stocks to use ratio, because this is one ratio which gives us a holistic view of supply and demand of a particular commodity. And it also illustrates how stocks will be mapped to the demand. So going by wheat and corn stocks to use ratio, we can clearly establish that supply of these grains remains tight across the world. Starting with wheat, stocks to use ratio in Europe, which is one of the major consumer, producer, and exporter, is forecast to reach near record low in the marketing year 23-24. Global ratio of wheat, excluding China, is forecast to reach a 16-year low during the year. Supply situation for wheat is expected to aggravate further as wheat and corn output in Australia, one of the largest exporter of wheat, is forecast to drop by close to 35% on an annual basis in 2023. And this decline will primarily be driven by a projection of severe drought in the country, which will be because of El Nino weather conditions that is developing. In addition, ongoing drought conditions in Argentina might lead to a deterioration in the country's wheat and corn output as well. While situation remains slightly better for corn as visible in the chart, overall supply of the commodity in some of the key consuming nations will likely remain low. If we look at stocks to use ratio in Europe, it is forecast to reach about 4-year low in the marketing year 23-24. Global ratio, as visible, it is expected to reach or remain below the last 5-year average level in the marketing year 23-24. Now, the ratio in Argentina, which is one of the key exporter of this commodity, is projected to reach a record low of 1.9% in the ongoing marketing year. Considering this all supply situation for particularly for corn and even for wheat, US could play a pivotal role in this situation, as the country is expected to see a sharp rise in stocks, primarily because of a 10-year high acreage for corn in 2023, which has basically resulted into higher production in the US. Now, after assessing the El Nino impact on output and prevailing supply-demand fundamentals, let's understand how these will impact price movement of these grains. Starting with a brief background, prices of these grains began to trend downward in June 2022 and has maintained its downward momentum primarily because of increased supply and weak demand from the feed industry. Now, supply remained higher because one of the largest producer, Brazil, particularly for corn, saw a record high harvest in this year. In addition, output for wheat, particularly in Russia, US, and Europe, also increased, and hence leading to improved supply in the spot market. In addition to that, conclusion of Black Sea grain deal also helped increase in supply for Ukraine and Russia. This overall collectively led to higher global supply of these grains. Now, despite expiry of the deal, Russia has continued to ship grains at a robust rate, and which is primarily driven by a substantial high carryover stocks from the previous marketing year and a relatively high volume of production in the ongoing marketing year. This has particularly allowed the country to remain very competitive in the exports market and hence pricing its shipment slightly lower versus its key competitors such as Europe. Demand rationing because of cost of living crisis, which is driven by a steady hike in interest rates by the global central bank and a slump in demand from the poultry feed industry because of a significant outbreak of avian influenza in US and Europe also contributed to the downward pressure on grains prices. Moving forward, if we solely consider the historical El Nino occurrences, it appears that global food supply and prices are unlikely to experience a significant fluctuations or volatility. However, when we combine the potential impact of a more intense El Nino event between fourth quarter of 2023 and first quarter of 2024 with other critical factors, it suggests that grains prices may have already reached their medium-term low and are poised for a probable rebound from this point onward. And the primary factors which will be leading to this increase are, First is lower than estimated output in Canada and Europe because of unfavorable weather in the region. While Canada is battling with dry weather conditions, on heavy rainfall during the ongoing wheat harvest season in Europe impacted production, and as a result, cumulative wheat output in the major wheat producing countries of Northern Hemisphere, including Europe, US, Russia, Ukraine, and UK, is forecast to drop by close to 2.3% on an annual basis. Ending stocks in these countries and regions is forecast to slump by close to 12% on an annual basis. Another factor which will certainly indicate supply tightness is intense impact of El Niño weather on Australian and Indian wheat acreage and production. Such a situation, wherein Australia is expected to see a sharp dip in production, it may force Asian buyers to target Western nations to meet demand in order to control price inflation in the domestic market. Another important factor will be escalation of tensions in the Black Sea region. Russia and Ukraine both continues to attack its infrastructure, particularly Russia targeting Ukraine's grain and port infrastructure, which is likely to keep supply uncertainty intact in the short term. On demand side, there are high possibility that we may see increased pace of demand growth from China and India. Particularly for China, heavy rainfall in the Heilongjiang province of the country is expected to affect country's corn output and yield, because the province accounts for about close to 15% of its total production. Additionally, China also saw a large portion of wheat getting damaged because of heavy rainfall during the harvest season, which has made a certain portion of wheat unfit for even feed consumption. A deficit monsoon in India is also raising expectation that the government might think of importing grains, particularly wheat, in order to control inflation in the domestic market. Now, let's look at other factors to watch out apart from El Nino. So the events that may pose risk to our price forecast are: the first and foremost is logistical issues because of low water levels in the Mississippi River and Panama Canal. Now, since we were focusing on particularly on US wheat grade, so a drop in water level has caused a significant impact in the movement of grains from farmers to Gulf Coast, which is leading to basically improved supply in the US spot market. And while on the other hand, it has basically pushed up barge rates, prompting some companies to reduce their barge loads as well. So in overall, while this is going to have a negative impact on US domestic market, it will likely push up exports premium and may support global prices. The second bit is escalation of geopolitical tension. While we did discuss about Russia-Ukraine crisis, there does not seem any light at the end of the tunnel, as Ukraine has increased its counter-offensive move against Russia, which continues to target Ukrainian port and grain infrastructure. While such a situation continues to affect grain exports from Black Sea, escalating disagreement between Ukraine and Poland may disrupt shipment from land route as well. The third key factor will be worsening of drought in Argentina. So the current condition is the country continues to face worst drought in its history, and it is basically leading to significant impact on grain sowing in the country. Going forward, if the country, which is the third largest corn exporter, does not witness a good rainfall in October, which is again a key sowing period, farmers may choose to reduce sowing area, which might have a significant impact on output and yields. The fourth bit is quality deterioration, which may happen if the countries see a significant rise in rainfall ahead of the harvest season. Some countries in Europe, such as Germany and China, has already faced quality deterioration issues in 2023 because of rainfall. In addition, rains ahead of the harvest season may also delay harvest, further raising concerns about quality and moist issues in the crop. For sugar, possibility of export ban by India is something which may, if implemented, lead to a significant price rise. As my colleague Nidhi already pointed out, that earlier in the session, that stocks to use ratio for global sugar market is likely to decline to a 13-year low. And if the government decides to impose export ban, that will significantly impact global sugar deficit. The last bit is disease spread in Africa, which will further impact supply of cocoa. Now, after having discussed the prevailing supply-demand fundamentals and mapping it with increased possibility of stronger El Nino, it seems that ingredients cost will likely increase in the short to medium term. So, the key question is how the business can mitigate the impact of price rise. Here, so the first and foremost step is we should prepare in advance to mitigate cost pressure. Identifying potential substitutes and the associated expenses involved in transitioning to these alternatives should be clearly evaluated. Early planning provides a crucial advantage in situations where shifting to alternative option becomes necessary for ensuring business continuity. The second bit is the business should avoid being too reliant on a single provider and territory, particularly when the manufacturer is purchasing from areas where the commodity is declining or is expected to get affected. Supply chain professionals should improve inventory and labor planning to mitigate the impact of potential disease and weather-related disruption. One should carry out detailed assessment to gauge the necessary levels of inventory, as well as ensuring that the required inventories are in place in the event of supply chains getting disrupted due to low production from key exporting regions. Lastly, it is imperative to monitor disease outbreaks and adverse weather conditions as they evolve. Looking at El Nino, business must continue tracking its progress very frequently and assess the potential consequences the weather event may have on key geographies and suppliers. So this is all what we had for today's session. Thank you all for your time. We'll be happy to answer your queries.
Thanks, Kumar. Thanks, Nidhi. Now, in the interest of time, I think we will quickly open the forum for question and answers. And I think we have a couple of questions. So just let me ask. I think first, Kumar, is for you. Elstor Leonardo is basically asking, if you have a reading of how long this El Nino will be at this stage, and if we have an estimate of reduction for next couple of months, mainly for Brazil and Argentina, which are greatly impacted by excessive rain.
So, particularly for if we look at South American nations, so yes, these countries should ideally receive higher rainfall. However, considering that at present the probability of a stronger El Nino is somewhere between February and March of 2024. We do expect that it may impact slightly to yields, particularly because the current conditions, particularly in Brazil, is very favorable for sowing conditions. So the farmers should ideally be sowing higher acreage. So even if we see a slight impact on yields, production, particularly in Brazil, is going to remain higher.
Okay. Thanks, Kumar. Nidhi, next one is for you. For veg oils, when do you think is the right time to cover for second quarter of 2024?
For second quarter of 2024, I think it would be better to wait till end of quarter one of 2024 because at that time it marks the beginning of soybean harvest in Brazil and Argentina, which are the largest producer of the crop. And also during this period, it coincides with the peak production period for palm oil in Indonesia and Malaysia. So supply of vegetable oils increases during this period, and that would push down the prices, and hence it will provide a good opportunity to cover for quarter two requirements of 2024.
Okay, great. The next one is on cocoa. Again, Nidhi, for you. Given the tight cocoa supply situation, what is the possibility of contract defaults by cocoa exporters?
So usually there is a possibility, I would say, for cocoa exporters to default on their commitments if supply situation worsens further. Also, for now, the cocoa regulatory bodies in Ivory Coast have reduced their cocoa bean contract sales by about 18% for marketing year 23-24. Also, in February 2023, we did see that their cocoa exporters faced the risk of default, and they witnessed a shortfall of about 150,000 tons of cocoa. So yes, there is a possibility of default.
Okay. The next one is for you, Kumar, and it's on wheat. The production outlook indicates a tight supply of wheat moving into 2024. However, the quantum of increase shown in your outlooks seems modest. Could you elaborate on that?
Sure. So basically, while we do expect that supply of wheat is going to remain tight, the primary factor why we have limited the price rise is because one of the key consuming industry for wheat, feed industry, is expected to see a significant decline in demand. And that will primarily be driven by low herd count, particularly for cattle and sheep, and across US, Europe, and China. And that's the key reason why we have limited price hikes.
Okay. Nidhi, I think next two questions is on sugar, right? So considering Brazil will see high sugar output next year owing to El Nino, what do you think? Again, it's what will be the best time to cover for second half of 2024?
Mm, So it is better to wait till end of Q2 of 2024 to procure for the second half of the year because this would be the time when Brazilian sugar crop will start entering the market. And as you correctly said, that sugar output from Brazil is likely to be higher in the next year. So that might drive down the prices, providing an opportunity to procure for second half. Additionally, by that time, it's likely that we get clarity on the Indian sugar export stance if the government is reducing it or banning it, further providing clarity for the sugar market. So, yeah, quarter two would be the better option to procure for H2.
Okay. Another related question is, what is the impact? Again, this is for sugar. So what is impact on US market, given the fact Brazil has good harvest forecast and Mexico increases exports to US?
So, in US market, firstly, it's a very heavily regulated market. The export quotas are fixed under the tariff program of the country. And US is also expecting a drop in its sugar output for next year, even though a marginal drop. So that will imply that there would be a shortfall in the sugar market. So given that even though Mexico is expected to have a bumper, a higher crop next year, and the imports of sugar from Mexico to Brazil are likely to increase, but again, it's worth noting that overall as of now, US has not increased its overall sugar quota under its tariff program. So the prices may have some impact or negative impact because of its high carryover stocks from the marketing year 22-23, as US imported heavily during that period. But again, that will not really, be bullish for the prices in Europe. Bearish for the prices in Europe, in the US. Sorry. Overall, the prices may increase in line with the global trend because as US is also expected to have a tight production, lower production, and even though imports from Mexico to increase, but again this has not resulted in overall increase in the imports for the country. So in line with the global tightness, the prices in US are likely to remain elevated. In US is also likely to remain elevated for sugar.
Great. Thanks, Nidhi. And Cindy, I hope this answers your question. Next one is for you, Kumar. What is the downside risk to the corn price forecast? And do you expect prices to decline further? What is your recommendation on covering the first half of 2024 requirement?
So downside risk to price forecast will be very limited. So only risk is if the yields turns out to be slightly better than what we are expected in Brazil. So considering the current supply demand situation, we basically expect the prices to increase, and hence the ideal recommendation in this situation will be that one should initiate its discussion on covering requirement for H1 2024.
Okay. And the next question is, I think, for both of you. So price trends you are showing are for which market? How does it take into account the Black Sea corridor situation? So Kumar, maybe first you can answer what regions we showed on the presentation, and then Nidhi, you can talk about the soft and the veg oils.
So in this session, we have focused on price for basically US market. While we have accounted this Black Sea corridor situation in our price outlook, and we discussed about this as a risk and the price driver as well.
Okay, Nidhi, very quickly, for which regions we basically showed the analysis for cocoa, sugar, and veg oils?
Yeah, so for cocoa, it's London cocoa, and sugar is a global sugar 11 grade. And for
Okay,
vegetable oils, soybean oil is for US and palm oil is for European region.
perfect. Last couple of questions. When you talk about El Nino, do you see an impact on any other sector other than agriculture? Nidhi.
There would not be any significant impact on other sectors. Mining could be impacted in Brazil because of heavy rains that might close the mines temporarily. And it may also impact mining in Asia because of extreme dry weather. So, however, the impact on the prices would only be there if these suspensions are prolonged. Small temporary suspensions will not really impact the prices of commodities.
Okay, so this is the last question for this session. So just requesting everyone, if they have like any further question, please post in the Q&A box. So this is for you, Kumar. What will be the impact on the production of rice?
Well, so for production of rice, so two of the key producing regions like India and Thailand is certainly going to see a deficit rainfall, and hence we expect the production to be slightly lower compared with the previous year.
Great. Okay. Guys, I think there are no more questions left, and I think we are on time. So yeah, I think that's all for today. And thank you all for your time, and wishing you a great rest of the day or evening ahead. Thank you. Bye-bye.